Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that can seriously level up your trading game: chart patterns. I know, charts can look like a bunch of random squiggles at first, but trust me, once you learn to read them, they tell a fascinating story about what the market is thinking and where it might be headed next. Think of it like learning a new language, the language of price action. By understanding these patterns, you're not just guessing. You're making informed decisions based on historical behavior, which can dramatically enhance your trade execution. So grab a notebook, and let's get started on decoding these powerful signals. First up, let's talk about the two main categories of chart patterns: continuation patterns and reversal patterns. It's pretty much what it sounds like. Continuation patterns, like flags, pennants, and rectangles, suggest that after a brief pause or consolidation, the price is likely to continue moving in its original direction. Imagine a sprinter taking a quick breath before continuing the race. That's a continuation pattern. On the other hand, reversal patterns signal that the current trend is running out of steam and is likely to change direction. These are the patterns that can help you catch the beginning of a new trend, and they include famous ones like the head and shoulders, double tops, and double bottoms. Recognizing whether the market is just taking a breather or is about to make a U-turn is a fundamental skill for better trade timing. Let's break down a classic reversal pattern, the head and shoulders. This one is a huge favorite among traders because it's relatively reliable. When it forms correctly, it looks just like its name suggests. You'll see a peak, which is the left shoulder, followed by a higher peak, the head, and then a third, lower peak, the right shoulder. All three of these peaks pull back to a similar support level, which we call the neckline. The real magic happens when the price breaks below this neckline after forming the right shoulder. This breakdown is a strong bearish signal, suggesting the uptrend is over and a new downtrend is beginning. A trader might use this breakdown as a signal to enter a short position or sell an existing long position. The key is to wait for that confirmed break of the neckline, not to jump the gun. Now, what about its opposite? That would be the inverse head and shoulders. It's the same pattern, just flipped upside down, and it's a bullish reversal signal. You'll see a trough the left shoulder, followed by an even lower trough the head, and then a third, higher trough the right shoulder. The peaks in between these troughs form a resistance line, our neckline. When the price breaks decisively above this neckline, it signals that the downtrend has likely ended and a new uptrend is about to start. This is your cue to look for buying opportunities. The beauty of these patterns is their symmetry. Once you understand one, you automatically understand its inverse. Remember, patience is crucial. A confirmed breakout above the neckline is what validates the pattern and gives you a much higher probability setup for your trade. Let's move on to another popular pair of reversal patterns: double tops and double bottoms. A double top looks like the letter M. The price rises to a peak, pulls back, and then rises again to a similar level as the first peak, but fails to break higher. This failure to make a new high is a red flag. It shows that the buying pressure is weakening. The pattern is confirmed when the price breaks below the support level, or the trough, that was formed between the two peaks. This breakdown is a bearish signal, indicating a potential trend reversal to the downside. It's like the market tried to break through a ceiling twice and failed, and now it's ready to head back down to the floor. This is a classic signal that sellers are taking control from the buyers. Conversely, the double bottom looks like the letter W. The price falls to a low, bounces up, and then falls back to a similar low level, but fails to push lower. This is a bullish sign. It shows that selling pressure is drying up and buyers are starting to step in around that price level, creating a strong floor of support. The pattern is confirmed when the price breaks above the resistance level, or the peak, between the two bottoms. This breakout is a strong signal that the downtrend is likely over and a new uptrend could be starting. For traders, this is a potential signal to go long. Like with all patterns, look for a significant increase in volume on the breakout. This confirms that there's real conviction behind the move and it isn't just a fake out. Now, let's switch gears to continuation patterns. One of the most common is the flag pattern. This pattern forms after a strong, sharp price move, which looks like a flagpole. Following this sharp move, the price enters a period of consolidation, moving sideways or slightly counter to the trend within a small, parallel channel. This channel is the flag. A bullish flag appears during an uptrend, and a bearish flag appears during a downtrend. The idea here is that the market is just taking a quick pause and catching its breath before continuing its original strong move. Traders will watch for the price to break out of the flag channel in the same direction as the initial flagpole. A breakout from a bull flag is a signal to buy, while a breakout from a bear flag is a signal to sell short. Very similar to flags are pennants. They also form after a sharp price move the flagpole, but the consolidation period is different. Instead of a parallel channel, the price consolidates within converging trend lines, forming a small, symmetrical triangle. The pennant. Like a flag, a pennant represents a brief pause in the market. The converging trend lines indicate that volatility is decreasing before the next big move. The trading signal is the same. You wait for the price to break out of the pennant in the direction of the preceding trend. A breakout to the upside signals a continuation of the uptrend, and a breakout to the downside signals a continuation of the downtrend. These patterns are powerful because they often lead to moves that are just as explosive as the initial flagpole. So, how do you actually use these patterns to enhance your trade execution? It's not just about spotting a pattern. It's about building a complete trading plan around it. First, use the pattern to identify a potential entry point. This is usually the breakout of a key level, like the neckline of a head and shoulders or the trend line of a flag. Second, the pattern can help you set a logical stop loss. For example, in a double bottom, you could place your stop loss just below the lowest point of the W pattern. If the price goes back down there, your trade idea is clearly invalidated, and you get out with a small, managed loss. Third, patterns can even help you set a profit target. For many patterns, like the head and shoulders or flags, you can measure the height of the pattern and project that distance from the breakout point to get an estimated target for the price move. Remember, no pattern is 100% foolproof. The market can and will do whatever it wants. That's why context is everything. Always look at the bigger picture. Is the overall market in an uptrend or a downtrend? Is there a major economic news event coming up? Also, pay close attention to volume. A breakout on high volume is much more significant and reliable than one on low volume. High volume shows conviction. Think of these patterns not as crystal balls, but as tools that give you a statistical edge. By combining pattern recognition with good risk management and an understanding of the broader market context, you can significantly improve the quality of your trade setups and your confidence in executing them. Practice is key. Open up some charts and start trying to spot these patterns in historical price data. The more you see them, the faster and more accurately you'll be able to identify them in real time. That's all for today's deep dive into chart patterns. I hope this has helped demystify them a bit and shown you how powerful they can be for your trading. Start with the basics we discuss: head and shoulders, double tops and bottoms, and flags, and get really good at identifying them. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you don't miss our future content. Drop a comment below and let me know which chart pattern is your favorite to trade. Thanks for watching, and I'll see you in the next video. Trade smart.